some single country that has less exposed to US and Europe, then look at this chart. This is the exports of goods and services as a percentage of GDP. Okay? And these 4 countries are very low exposure, have very low exposure of export of goods and services. And they are, just in case you can't read from the back, India, Indonesia, China, and Philippines. Okay? So in other words, if you do not want to have exposure too much to the West, you want to find an investment in a single country that are very domestic driven, then you can consider India, Indonesia, China, Philippines. Okay? For India and China, we have a fund, Pro-Asia Select Income Fund, where we have 60% in fixed income, 40% in India, China. Okay? So if you want an India-China exposure with a bit of bond exposure, then you can consider that fund. For China, we also have a Pro-Dynasty, which is a Greater China Fund. So that will give you exposure to China. For Indonesia, we also have recently launched a Pro-Indonesia that will give you exposure to Indonesia. Indonesia has a very good structural story in the long run. India and China, I don't have to say because everybody knows that they are going to be very big economies in future. And in fact, these 3 are going to be very big. Philippines is also emerging, but then again, Philippine market may be a bit too small. So therefore, if you want to play a Philippine market or you want to play as a whole of India, Indonesia, China, Philippines, or Asia as a whole, you can also consider our Asia Pacific Equity Fund or Asia Pacific Sharia Equity Fund. Okay? These are the Asia exposure. So you can actually position your investment into Asia because Asia is still growing very well. In fact, Asia, you're talking about China first half growth is 9.5%. Even if slow down, it's going to slow down to 9% or 8.5%, it is fine. India, 8% growth is quite normal for India. Okay? If it slow down, 7 to 8%. Okay? We think Indonesia, 6% is decent. And the other part of Asia could be about 4-5%. So we are still showing a very good signs of good growth within Asia, even though export will slow down. Because a lot of these countries, especially the big economies, actually are very much a domestic-driven economies. And you look at Asia, European exports, most of them are less than 10% of GDP. The one in red is actually China, actually have a very small exposure to Europe. How about the banking system? This chart, Tier 1, 8%, it is a Tier 1 capital. If any bank that have a Tier 1 capital more than 8%, they are well capitalized. This is LDR, is a loan to deposit ratio. Anything above 100 means the bank or the banking system lend more than deposit. Okay? Anything that's below 100, it means that they have more deposit than lending, so they are safer. So you find that those bank or those banking system in this country are safe. Okay? The one that are quite highly lend out are Korea, Australia, and Thailand. Otherwise, the other banks in Asia are quite strong. Okay? They are quite strong. Of course, we are not talking about scenarios similar to 2008 Lehman crisis. If you're talking about a scenario similar to Lehman crisis, then the banking sector may have a D rating. Okay? D rating means being downgraded. So overall, Asia, if you want to invest in the region that have high growth, Asia growing faster than US, Eurozone, Japan. So you should pick Asia Pacific ex Japan. Okay? And Asia corporations, they have reduced their debt level over the years. Okay? So over the years, they've reduced their gearing, and currently the balance sheet are quite healthy. And in fact, if you look at the earnings forecast, for developed market, most of the earnings forecasts are downgraded. And in Asia, we still have a mix. Some upgrade, some neutral, some downgrades. Asia corporations, very healthy. Return on equity, rising. It means the profitability increase. Debt ratio falling, which means they deleverage. Okay, they pay off their debt, so they are healthier. And then interest coverage, rising. Means their capability to service the interest increase. Okay, so these are very healthy. So Asian corporations as a whole are quite healthy. And yet this is the valuation. This is this one, unfortunately, you can't see the yellow line. Huh? You cannot see a yellow line. Actually, there are lines here. Okay, let me show you. This yellow line, about 12 to 13 times, This is the historical average. Okay, 12 to 13 times. Huh? This is the historical average. When it comes to this level, it is very attractive. The line show you it is very attractive. Anyway, if you want this line, you can actually get it from us, okay, Adeline or whoever in charge, or Amy. Okay, we actually will provide you this to be able to explain to your client. What the chart show you, this is very important chart. You know that Asia is growing. You know that Asia is not having any recession. But because of the US and the Europe panic, they are now assuming there is a recession in Asia. Valuation just collapsed. Okay? Collapse. Historical average is 12 to 13 times. This one haven't really updated. By now, it is 9 over time. Slightly more than 9 times. So slightly more than 9 times price to earnings ratio. Some people say, we are not here no? After the recent correction, because I did my road show for about 2 weeks plus. So if I update this number, it should be around here. It should be 9 times. Slightly more than 9 times. Okay? 2008, it was 8 times. So 2008 is a financial crisis, global financial crisis. Unless you're expecting the similar thing to happen, then maybe we're back to the 8 times. But we're already 9 times. 9 times is cheap. If you take a view, a long-term view, or perhaps just 1 year to 3 year view, just take a 1 year to 3 year view. It is not difficult for the market to go back up to the historical average of 12, 13 times. And from 9 times back to 12, 13 times, you have quite a decent upside. Okay? And every time, when the market bounces back to the average historical level, they tends to overshoot. So when people are positive, they become very positive. When people are negative, they overshoot on the downside as well. Okay? So that's why as an investor, you want to look for opportunity. You don't miss out. This one. As it grow nearer and nearer to this level, I think it is very good for you to slowly start to invest. Because if you have a 1 to 3 year time frame, if you have a 3 to 5 year, it's even better. But if you have 1 to 3 year, even at a 1 year time frame, the current level are actually very attractive. But my advice is that some people may ask me, shall I put in the money now? No, because since it's so cheap. My advice is slowly, because things are still not settled yet in Europe. They haven't really come up with any solution that is solid enough to solve the Europe problem. Okay? So there are still chances of a financial crisis happening in Europe. There are still chances of financial crisis. Okay? I will not go into very detail on Europe because if I go into too technical, you may all fall asleep. Okay? But the take is that they haven't really solved the problem. But because the correction is so sharp and things are so cheap, like what happened 2 days ago. Whenever there's rumor that people are going to come up with some sort of solution for Europe, market rebound. Why? Because things are too cheap to be ignored. If things are too cheap to be ignored, you try to find a reason. You try to find a small reason for you to buy. So when everybody tries to find a small reason, some improvement. So, the rebound will be quite sharp. This is what happened in 2009 as well. Well, of course, we do not know the bottom. As I said many times, if I know the bottom, I wouldn't have working for people already. I would have been very rich, right? Goyang kaki. But anyway, my boss is not here, so it's okay. But anyway, nobody know the bottom. But as long as you are quite close to the bottom and you know that things are cheap, you look at the 1 year, 3 year horizon, you are okay. Okay? Don't be too, just try. I try very much to look at bottom and sometimes you just miss it. How many of you missed the 2009? There are a lot of people, actually, when the 2008 started correction that time, a lot of people want to buy. After they buy, lost money, and they start cursing. What is happening? Okay? So after a while, they pull out from the market, totally don't want to see. And then when the market rebound, is it real that the market rebound? Cannot be. Economy hasn't really settled. The uncertainty is still there. Yeah? Economic uncertainty is still there. But as long as there is a bit of improvement, the market actually rebound. And they miss out the whole thing. There are people actually miss out the whole trend of the rebound. So what I want to show you is that when things are cheap, you do not know the bottom, you start putting in slowly, gradually investing. But you must make sure that you still have bullet. When I say bullet means that you still keep some money in case it drops cheaper and cheaper, you can still continue to invest. Not to the extent you put in so much, and at the end, when they really come to a really cheap level, you got no money. So that's why I encourage you to slowly go and talk to your investors or clients to look at the longer term view, whether they have this risk appetite. If your client do not have a risk appetite at all in equities, they cannot stomach that kind of losses. 3-5% losses, fear people just scared away. Then you may want to help them to look at some of the products that's suitable for them. For example, some of the mixed asset. Mixed asset means that a combination of bond and equity, or do a portfolio for them, or ask them to switch to Pru bond, or if they still like the Asia exposure, ask them to look at some of the fund of some of the country that has sold out a lot. Like for example, China. China was one of the last worst performing market last year, and this year continue to correct. So you have almost like 1.5 year of correction. And as I said, normally the bear market will not last too long. So already the market is being sold down so badly, so long. Okay? So it's just a matter of time when things are improving. I see the people may come in to buy. I always also mention about the China, how cheap is the China market right now. We talk about 8.7 times price to earnings ratio. Last week I quote the same thing. After correction, I quote the same number. But nevertheless, it is at about 8 times price to earnings ratio. Okay? Versus the 2008 low level of 7.4 times price to earnings ratio. It's actually quite near, And you're talking about China market, on average, the average price to earnings ratio is supposed to be about 12-13 times. So as long as you're looking at the longer term scenario, investment horizon, from 8 times, go back up to 12-13 times fair in the longer run scenario, right? And from 8 times to drop further, you may have a further downside if things get worse into a financial crisis. But as I said, the valuation is quite cheap now. Okay? So you can actually put a bit of your own judgment on how cheap is the valuation. As I said here, it should be around here now. This is also another Z-score is actually to measure whether the company is bankrupt. But anyway, we use this regionally. We use this Z-score to see how cheap. And in fact, it is very cheap. If you don't know how to read this, it's okay. It's fine. It's using price to book. This chart will show you that this is the earnings forecast. And this is the earnings revision over the last 3 months. What happened is that early of the year, a lot of people are the analysts especially, are very positive about the economy. Especially when US numbers seems to show up quite nicely in the beginning of the year. So because of that, there is a lot of optimism built in the number. And now, the reality is people started to be more realistic. They start cutting the number. The way we look at it, why I mentioned don't rush in too fast and use up all your bullet is because I think the earnings cycle, downgrade cycle are still happening. There's still a bit of profit forecast being cut, and more is likely. So which means they may cut the numbers further. So as they cut the number further, the PE ratio will then move out a bit. Okay, you need a more price correction. So because of a bit of downside on that front, as well as not clear yet on the cloudy picture of Europe, especially. So you just have to position yourself slowly, go gradually. Okay. So it's quite simple, right? Now this chart too small for you, but I just read out some of the number. Like for example, we're talking about Taiwan. Taiwan current valuation is PE valuation is at 44% discount to 10-year average. 44% discount to 10-year average. China market currently price to earnings ratio is 26% discount to 5-year average. And of course, Brazil, South Africa, we have a few. So overall, despite Taiwan, China, dividend yield higher, PE ratio is actually cheaper. Even in this region, if you look at US, the MSCI World are all around 10 times or below. So it's very attractive valuation. Okay. So this is the investment case for Asia. If you want to find growth region, Asia is your choice. Okay. We have, just now I already mentioned a few funds that you can consider in Asia. And we believe that in Asia, domestic-driven economies especially will do very well. And we do think that sell-off is actually too much, and it offers good buying opportunities for us. Okay.